Sydney house price growth continues, but modestly. The auction clearance rate has come through at a headline level at 74.9%. But what's the real story? Now, the RBA is expected to cut cash rate next week, but how much will it move the dial? And the Chalmers roundtable is shaping up long-term reform. And finally, 3 Foster Street leads a new wave of lifestyle-led homes. G'day, folks. It's Matt Hayson here with The Word, where we cut through all the noise and look at what's really driving Sydney's property market this week. Let's start with the auction scene. As I mentioned, the preliminary clearance rate in Sydney came through last weekend sitting at 74.9%, which looks strong, and it's created a bit of buzz in the media around being a seller's market. But when you look at the deeper level and the final clearance rate, it came through at 55.4% according to SQM research. And compared to the first week of July, look at these auction volumes. They've fallen 18% from 922 down to 755 last week. Now, while the real number of homes that have sold at auction have barely moved, 234 to 240, so what's really happening? Well, it's less stock, not more demand, is lifting the clearance rate. Buyers are active, yes, but they're still very cautious. This isn't a boom or even a seller's market. It's a market moving at a very steady pace with buyers focused on quality and on value. Also, Sydney prices have risen 0.6% in July, bringing the annual growth in Sydney to 1.8%. That's a positive step forward, especially given the cost of living environment, but it's very measured and it's not runaway price growth. The underlying theme here is that supply constraints are doing the heavy lifting more than economic strength. Even the AFR headlines are putting it, a rate cut won't change that. It's growth that's holding steady, not accelerating. Now, next week, as we all know, the RBA is widely expected to cut the cash rate by 25 basis points, and financial markets are even now pricing in up to 3 cuts by the end of this year. This is certainly welcome news, as it may ease some of the pressure on households and improve confidence, but it's important to keep perspective because mortgage repayments remain historically high, wages are flat, and economists, including former RBA board members, have made it quite clear rate cuts alone won't fuel a full recovery. Still, this is another clear step towards an easing cycle, and for some buyers, it could certainly be the psychological nudge they need. Now, let's zoom out to the political stage and policy stage, because Treasurer Jim Chalmers is hosting a productivity roundtable later this month. On the surface, it's all about cutting red tape and housing efficiency, but in the lead up, it tells a very deeper story. We've seen things like public modelling on capital gains tax, negative gearing, and super reforms. Think tanks that are pushing around ideas around trusts, inheritance, and also pensions. The Productivity Commission is floating a 5% cash flow tax and AI copyright law changes. Now, the government has since softened some of this messaging, but the ideas are now in play. And why does this matter for property? Because these reforms could absolutely change how we invest in properties, how they're taxed, how family wealth is passed down, and how ownership vehicles are structured. It's not so much a cause for panic just yet, because this is something to watch, but we'll be keeping a very close eye on this round table and see what emerges. Now, amongst the broader market caution, distinctive design-led homes are absolutely drawing attention, and this one is an absolute standout. At 3 Foster Street in Leichhardt, the old Lindsay toy factory is a remarkable warehouse conversion. 347 square metres of internal space, soaring steel trusses, polished concrete, and restored brickwork, a luxurious master bedroom suite, private garden, home cinema, and triple parking. It blends lifestyle, heritage, scale, and it's all coming to market, and buyers are responding very well. We're seeing a clear trend emerge where quality homes with soul are outperforming their generic peers, and this is a great example of what's to come as the spring market approaches. So here's our read on the market. The market is steady, not surging. Clearance rates, they are being propped up by low stock. Price growth, it is positive, but it's also modest, and a rate cut is coming, but we also expect increased listings too. Now, sellers, they should remain engaged and responsive to feedback, but buyers are here, but they're also backing quality and caution in equal measure. So on the CH Mood Metre this week, we sit at 6.8 out of 10, a reflection of confidence holding with a side of pragmatism as well. So that's what's going down in and around the market this week, folks. Thanks so much for watching, and I look forward to catching you all next week.